What if I told you an easy way to always set a perfect take profit on your trades? In fact, using this strategy made my bots 15 times more profitable, as you can see on the backtest right here. The best thing about this is you don't need to have years of experience or spend a lot of time in front of the charts, but it can be applied instantly by anyone. I'm sure you've faced the following situation a lot of times. You're looking at a potential trade and started the chart to look for the perfect entry, stop loss and take profit. You've opened the trade and set your stop loss and take profit. Next thing you know, chart goes in your direction and closes once it hits your take profit. Don't get me wrong, making a profitable trade is the first step to being a successful trader. But a lot of times what happens right after a trade was closed is that the chart still continues to go higher while you're sitting there frustrated by how much more profit could have been made. The next time you open a trade, you remember to set a higher take profit and dismiss your trading rules. Again, the chart goes in your direction, but now it barely misses the take profit and continues to go down to your stop loss. Now you're sitting there again, watching your trading strategy fall apart. This is a very common procedure of how in the beginning you follow all of your rules, but the more often your rules don't make a profit, you start to dismiss the rules and end up with no rules at all after some time. Just think about how you're setting your take profit on your trades. I know that most people set the take profit to previous swing highs or use any indicators like moving averages to trail the take profit. This is all done without considering how volatile this asset really is. Let's compare these two charts of Solana and BNB. If we only look at the candle from the 1st of October 2021, you see that Solana went up 14.41%, whereas BNB only went up 8.81%. Now, considering this, would you still set the same take profit on both coins? Probably not. There is a really easy way of figuring out how volatile an asset really is, and it's called the average daily range. The average daily range is a technical indicator used to measure volatility in an asset. It calculates the average difference between the highest and lowest price over a time interval. Luckily for us, there is a public script on TradingView available that calculates the average daily range of any given asset for us. You can find the link to the script in the description below. Once you've added the script to your favorites, open your favorite chart of Bitcoin and then add the script to your chart. The average daily range will now show up and tell you exactly how much an asset is most likely going to move. Average daily range is measured over the past 20 candles by default, but you can change it in the settings of the script. The higher you set the length, the smoother the daily average will be, but it also won't be the most accurate. On the other hand, if you set the average daily range to 1, you can see the volatility of each day. The best length is somewhere in between and also depends on the average length of your trades. If you're a day trader, it might be better to set a lower length, but if you're a swing trader with open positions for weeks or a couple months, better to set a higher average daily range. Generally speaking, a length of 20 to 30 is a very good starting point. If you take a closer look at the ADR, you will notice that it changes every single day. Whenever you open a new trade manually, I recommend using the average daily range as take profit on the day you open the trade. If you're using bots to trade like I am, I recommend changing the take profit once a week to keep up with the volatility trend. So let's compare my backtesting results when using a fixed take profit versus using the average daily range as take profit. If you want to know what strategy I'm using right here, make sure to watch the video in the info box. By using a 1% fixed take profit on BTC against USD, the strategy ends up making 0.065% daily. With a fixed 2%, this increases to 0.128%, and with 3%, it increases to 0.26%. These are really good profits, but it would be really difficult to guess the perfect take profit for the future. The backtest is easy to see how much an asset moved, but to predict this for the future is almost impossible. That's where using the average daily range comes in handy. If we use the average daily range with a length of 20 for this backtest, you can see that the daily profit instantly increases to 0.99% and is now more than 15 times higher than if we used a fixed 1% take profit. Using the average daily range to set the take profit almost seems too good to be true, and so there's one downside that I want to tell you. If you use a fixed 1% take profit, all of your trades will close very quickly because 1% on most assets is fairly easy to reach. This would mean that you get a constant dopamine kick because you see close trades almost daily. If you're using the average daily range to set your take profit, generally speaking, trades can take way longer to close out because maybe the current volatility is 15%, which is a lot harder to reach than 1%. Using 1%, you will close out the trades in a couple of hours, whereas using 15%, you need to wait a couple of days or maybe even weeks. However, overall, as you just saw on the backtests, using the average daily range drastically increases your overall profit. Personally, I strive to maximize the profit of my trades, regardless of how long they take to close, and I strongly believe that this is a very key ability to becoming a successful trader.